Right now, somewhere on your phone, there's a number. It represents your savings, your work, your security. And you trust it completely. Here's what nobody ever told you about that number. It's not money, it's a promise. And the system making that promise was never designed to keep it for everyone. Think of the global money supply as an iceberg. The tip above the water, that's physical cash. Economists call it M0, base money. Coins, banknotes, the stuff you can hold, fold, and stuff under a mattress. It's minted and controlled by central banks. The Federal Reserve, the Bank of England, the European Central Bank. It's finite, audited, real. But below the surface. That's M2, broad money. Every bank deposit, every savings account, every money market fund. M2 is 97% of all the money in the economy, and almost none of it physically exists. Here's where it gets uncomfortable. For every $100 sitting in your bank account, your bank physically holds about $3 to $10 in actual cash. That's it. In the US, the UK, and Europe, same story, different logo on the building. So where's the rest of your money? It was lent to someone else. Who deposited it somewhere? Who lent it to someone else again? One real dollar, lent and relent, creating 10 times that amount in digital money. The number in your banking app is not a record of cash stored somewhere. It's a record of what the bank owes you. Here's the distinction that changes everything. Physical cash is an asset. You own it, no bank can default on it. It exists in your hand. A bank balance is a liability, the bank's liability. It's their promise to give you cash if you ask. A promise that only works if not everyone asks at once. From the moment you opened your first bank account, you were trained to see these as identical. They are not. So here's the consequence. Every time a bank issues a loan, new digital money is created. More promises, more M2, more digits in more accounts. But the real world, the houses, the food, the goods, doesn't multiply at the same rate. More money chasing the same things, that's not a coincidence. That's inflation. And if you're holding your savings in cash, in a bank account, quietly feeling responsible, you're not storing value. You're storing promises. In a system designed to print more of them every single day. Understanding this is the foundation of everything we cover in this series. You probably learned about banks something like this. Grandma saves her money. The bank holds it safely. And when you need a loan, the bank lends you grandma's savings. Everyone wins. The system makes sense. There's just one problem. That's not how banks work. It never was. And what actually happens when you borrow money should make you stop and think twice. The myth: banks collect savings from depositors, pool the money, and lend it out to borrowers. The reality: banks create new money by typing it into existence the moment a loan is approved. When you take out a loan, a mortgage, a car loan, a business loan, the bank doesn't go to the vault. It doesn't check if grandma's savings are still there. It simply opens a new account and types in the number. That's it. Money that didn't exist 5 seconds ago now does. This is called credit creation. And it's not a theory. It's confirmed by central banks worldwide. Here's the part that sounds like magic, but is just accounting. When a bank creates a $500,000 mortgage, two things happen simultaneously. On the left, you're promised to repay. That's the bank's new asset. On the right, the number in your account. That's the bank's new liability. Both entries appear at exactly the same moment. The balance sheet balances. No existing money was used. Your debt is the money. They're the same thing, created in the same transaction. Money isn't printed in a government facility and then lent out. It's born the moment someone signs a loan agreement. If money is created through debt, follow the logic. For the money supply to grow, debt must grow. For the economy to expand, borrowing must expand. The system doesn't just allow debt. It requires it. Think about the last decade. Debt levels globally have surged. And so has the price of everything. Housing, food, education, healthcare. That's not a coincidence. New money created through loans enters the economy before it reaches your wage. Prices rise first, your salary catches up later. If it catches up at all, you didn't just miss out on a raise. The mechanism of money creation worked against you. This is why understanding the ledger trick matters. It's not abstract economics. It shows up in your rent, your groceries, your mortgage rate. Take a single $100 bill. Put it in a bank. Walk away. You think you just stored $100. The banking system thinks it just got $1,000. Your deposit isn't the end of the process. It's the beginning, the fuel, the first domino. Here's how it actually works. Walk through it step by step. Step 1, you deposit $100. Bank A now holds your $100, but it doesn't keep all of it. Traditionally, banks are required to hold a small fraction in reserve, let's say 10%. The rest, available to lend. Step 2, Bank A lends $90 to Sarah. Sarah needs money for a purchase. The bank creates $90 in her account. Your original $100 is still in your account. That's already $190 in the system from one deposit. Step 3, Sarah buys a bike. The bike shop receives the $90 and deposits it in Bank B. Now Bank B can lend 90% of that $81 to someone else. Step 4, Bank B lends $81 to Mike. Mike deposits it elsewhere. That bank lends $72.90, which gets deposited, which gets lent, which gets deposited again. The cycle keeps going. Each deposit becomes a new loan. Each loan becomes a new deposit. One real $100 bill. 10 times that amount in new digital money. Created from nothing but a chain of promises. Everything we just described assumes banks have to keep some money in reserve. A brake on the system. A limit to how much can be created. In the United States, in March 2020, that requirement was cut to 0%. 0% reserve requirement. Which means mathematically, the multiplier is now infinite. United States Federal Reserve, reserve requirement, 0% since March 2020. No legal floor on how much new money commercial banks can create through lending. United Kingdom Bank of England, no reserve requirement. Banks operate under capital adequacy ratios. They must hold a buffer of equity, not cash. The expansion ceiling is still enormous. Eurozone European Central Bank, minimum reserve ratio of 1%, the lowest in its history. Capital adequacy rules do the heavy lifting. Practical result, near identical to the US and UK. Different rules, different names, same outcome. Banks everywhere can expand the money supply far beyond the deposits they hold. Every central bank in the developed world has an official inflation target. They don't just accept monetary expansion, they design for it. Here's what the multiplier effect means for you personally. Every time a bank anywhere in the world issues a new loan, new money enters the system. The total supply of money grows. And your share of that supply, your savings, your salary, your balance, becomes a smaller percentage of the whole. You didn't lose any money, but the money you have buys less, because there's more of it chasing the same goods. That's not bad luck. That's not a market cycle. That's the multiplier effect working exactly as intended. Right now, somewhere in the world, a loan is being approved. New money is being typed into existence. The multiplier is running. And every new dollar, pound, or euro created through that process is a quiet, invisible tax on the money you already hold. Not a conspiracy. Not an accident. A feature. So the question isn't whether this is happening. The question is, what do you do about it? That's what the rest of this series is about. The entire global banking system rests on one thing. Not gold, not government guarantees, not law. Confidence. The collective, unspoken agreement that the numbers in our accounts are real. That the system will honor them. That today is not the day everyone finds out it can't. The math we've covered so far is just mechanics. We are talking about psychology, and psychology is far more fragile. Here is a fact your bank will never put in a brochure. Every bank in the world is technically insolvent. Not because of fraud or mismanagement. By design. They owe you your full deposit on demand. They hold a fraction of it in cash. The rest is locked in loans that can't be recalled overnight. The gap, a typical bank holds liquid cash equal to roughly 310% of its total deposit liabilities. The other 97% is tied up in long-term assets. This works perfectly. Until it doesn't. Imagine you hear a rumor. Your bank might be in trouble. You don't know if it's true. What's the rational thing to do? Withdraw your money first. Because if the bank does fail and you waited, you lose everything. If the bank is fine and you withdrew, you just have cash. The cost of acting is low. The cost of not acting could be total. But here's the trap. If everyone reasons the same way at the same time, the rumor becomes true. The rational act of self-preservation becomes the collective act of destruction. That's a bank run. A bank run isn't caused by a failing bank. It causes one. The fear is self-fulfilling. The psychology is the mechanism. Bank runs are not ancient history. They're just faster now. Northern Rock, United Kingdom, 2007. The first British bank run in 150 years. Customers queued physically around the block to withdraw savings. The images were broadcast live. The sight of the queue made the queue longer. Silicon Valley Bank, United States, 2023, $42 billion withdrawn in a single business day. No physical queues, just a thread on Twitter, a Slack message between founders and a banking app. By the time regulators responded, it was over. 1929, 2007, 2023. The technology changes. The psychology doesn't. And with digital banking, the speed of panic has gone from days to hours. Here's the part that's supposed to make you feel better. Most governments offer deposit insurance. A guarantee that if your bank fails, you get your money back up to a limit. United States, FDIC insures deposits up to $250,000 per depositor, per bank. Covers the vast majority of individual savers. United Kingdom, FSCS, covers up to £85,000 per eligible depositor, per bank, extended to £170,000 for temporary high balances. Eurozone, National Guarantee, SCHEMES, EU directive mandates €100,000 coverage per depositor per institution across all member states. For most people, most of the time, that's enough. Your savings are protected. The system holds. There's a cost to that guarantee that nobody talks about. It's called moral hazard. When banks know the government will step in if they fail, they take bigger risks than they otherwise would. The upside goes to the bank. The downside goes to you. The safety net doesn't just protect depositors. It gives banks permission to gamble. Every time you open your banking app, you are trusting a chain. You trust the bank to have your money. The bank trusts you not to ask for it today. The government trusts neither of you to break the spell. That's not cynicism. That's the architecture. And the question isn't whether the system is fragile. It clearly is. The question is, knowing that, what should you be doing differently? Think about the house you grew up in, or the one you're trying to buy. Same walls, same roof, same neighborhood. So why does it cost 3 times what it did 15 years ago? The easy answer is supply and demand. Not enough houses, too many buyers. That's partially true. But it's not the whole story. And the part that's missing, that's the part they never teach you. You weren't priced out because houses got better. You were priced out because the money used to buy them got weaker. Remember what we said earlier. When a bank approves a loan, it creates new money. That money has to go somewhere first. And where it goes first is not your paycheck. This was first described by an economist named Richard Cantillon in the 1700s. 300 years ago, still true today. The quantillon effect, new money injected into an economy doesn't distribute evenly. It flows to whoever receives it first, typically banks, large borrowers and asset owners, before prices have had time to rise. When a bank creates credit, that money moves into assets. Housing, stocks, land. These are the first markets new money reaches. So their prices rise first. Your wages rise later. Much later. If they rise at all. This is the chart that changes everything. 2 lines, 30 years of data. Red, median home prices. Blue, total money supply. They're the same line. Not similar, not correlated by coincidence. Near identical. Every surge in the money supply is followed by a surge in house prices. Every contraction matched. The post-2020 data, major central banks expanded broad money supply by 20–40% between 2020 and 2022. In those same markets, median home prices rose 30–50% in the same window. The correlation is not coincidental. The houses didn't change. The money did. Here's why this hits younger buyers the hardest. When new money is created through mortgages and loans, it flows to people buying property. Those buyers compete with each other. Prices go up. Meanwhile, that same money slowly filters through the economy. Eventually, wages rise. But by then, the house costs twice what it did when the money was first created. The gap in most developed economies over the last 20 years, housing costs have risen 3–5x faster than median wages. The gap isn't a market failure. It's the predictable result of where new money lands first. You didn't fail to save hard enough. You weren't irresponsible with avocado toast. You arrived at the market after the inflation, and before your wages caught up. That's the trap. So what is the invisible tax exactly? It's the purchasing power you lose every time the money supply expands, and your wages don't expand at the same pace. The diagnosis: inflation in asset prices is not random. It is the direct consequence of how money is created. New money enters through credit, lands in assets first, and raises prices before wages follow. The tax is real. It just doesn't appear on a receipt. Nobody sends you a bill for this. There's no line item on your payslip. But every year you hold savings in cash, while assets inflate around you. You pay it. Silently. Automatically. Without consent. Understanding this doesn't change the system. The money supply will keep expanding. New loans will keep being created. Asset prices will keep absorbing that money first. But understanding it changes what you do next. There are two positions in this system: those who hold currency while it dilutes, and those who hold assets while currency dilutes. We have covered so much already. You understand the system. Money is created from debt. It multiplies through banks. It flows into assets before it reaches wages. And it dilutes everything you hold in cash. So what do you actually do about it? You can't stop the money supply from expanding. That's not on the table. But you can move out of the splash zone. The goal isn't to beat the system. It's to stop being the one the system beats. Think of your cash savings as a block of ice. It looks solid, it feels secure. The number in your account doesn't go down. But in a world where money is constantly being created, holding cash is a choice to melt. Every year, the money supply expands. Your cash doesn't. So as a proportion of everything, of all the money in existence, yours shrinks. The rate of melt most central banks target 2% annual inflation. At that rate, cash loses roughly half its purchasing power every 35 years. In periods of elevated money supply growth, the melt is faster. Cash isn't a store of value. It's a starting point. The goal is to exchange it for something the system can't print. A hard asset is anything with a supply the system can't expand at will. No keyboard, no central bank meeting, no policy decision. 4 categories worth understanding. Real estate land is finite. Banks can create money to buy it. They cannot create more of it. Property absorbs monetary expansion because the supply of land is physically fixed. Equities, stocks, ownership in businesses that reprice with inflation. When a company's input costs rise, it raises prices. Revenue goes up. Stock value follows. You don't just hold money, you hold a share of productive output. Gold and commodities cannot be created from a spreadsheet. Gold has been a monetary anchor for thousands of years, not because it's magic, because there's a finite amount of it, and mining more takes real resources and real time. Bitcoin fixed supply cap, mathematically enforced. Maximum 21 million units, no central bank, no policy override. Whatever you think of it, the scarcity is structural and verifiable, unlike any government currency in history. Please note that this is not financial advice. Each asset class carries its own risks, volatility, and time horizons. This is a framework for thinking, not a portfolio prescription. Do your own research before making any investment decision. In your 20s, saving cash made sense. You needed liquidity, you needed options. An emergency fund, a deposit, a buffer. But that same behavior in your 30s or 40s stops being prudent. It becomes the risk. Not because cash is evil, because holding excess cash in an inflationary system is a decision to slowly lose. 3 moves in order. Step 1, build your emergency fund. 3 to 6 months of living expenses, kept in cash, liquid, accessible. This is your foundation, not your strategy. Cover your downside first. Step 2, deploy the surplus into hard assets. Everything above your emergency fund is being diluted sitting in cash. Move it into assets that historically match or outpace monetary expansion. Start simple. Stay consistent. Step 3, understand fixed-rate debt differently. This one surprises people. If you borrow at a fixed rate in an inflationary environment, time works in your favor. You repay with tomorrow's cheaper money. The debt shrinks in real terms. This is exactly how the system already works for those who understand it. None of this is about getting rich quick. It's about not getting quietly poor slowly. The system doesn't ask your permission. The money supply will expand. Assets will absorb the new money first. Cash holders will absorb the dilution. That's not fate. That's a choice. The system transfers wealth from those who hold currency to those who hold assets every single day, without exception. You now know which side you want to be on. With everything you have learned so far, now you know it's all one system, and it all connects. Let's close the loop. The illusion: 97% of money is digital promise, not physical cash. The ledger trick: banks don't lend savings. They create money when loans are signed. The multiplier: one deposit becomes 10 through the lending cycle. The confidence game: the system runs on trust. When trust breaks, it breaks fast. The invisible tax: new money flows into assets first, wages follow last. The escape: you can't stop the printing. You can move out of the splash zone. The banking system is not a conspiracy. It's an engine. It powers economic growth. But dilution is its exhaust. And if you're not paying attention, you're breathing it. Here is the single most important shift this series can give you. Stop measuring wealth in currency. Currency is the thing being diluted. It's the unit of measurement controlled by the system. If you measure value in dollars or pounds or euros, you're using a ruler that keeps getting shorter. Start measuring in something the system can't change. Old lens: that house costs $600,000. New lens: that house costs 14,000 hours of my labor. Is it worth it? Old lens: gold is at $2,000 per ounce. Expensive. New lens: gold buys the same amount it bought 50 years ago. Cash does not. Old lens: my savings are up 3% this year. New lens: did my savings outpace money supply growth? If not, I'm behind. These aren't tricks. They're just clearer lenses. Once you use them, the old way of seeing money never quite works the same again. Don't hate the player. Understand the game. Because once you understand it, you stop being the mark. 1. The number in your account is not money. It is a promise, one that works until it doesn't. Know what you actually own. 2. Every loan creates new money that dilutes yours. This is not a flaw, it is the design. The system needs debt to grow. Your savings absorb the cost. 3. The escape is simple, not easy. Emergency fund in cash. Surplus into assets, fixed-rate debt used strategically, measure in real value, not currency. 3 verdicts, all of them actionable. Starting today, the system is not going to change because you understand it. The money supply will keep expanding. New debt will keep creating new money. Assets will keep absorbing it before wages do. But here is what changes: you. The system is designed to move wealth from those who hold currency to those who hold assets. That transfer happens every single day, quietly, automatically, without a single headline. You know the rules now. Which side of the transaction do you want to be on? Every system has rules. Most people never learn them. You just did. This has been Brief Economics. If this changed how you see money, share it with someone who needs to see it too.